This is the Doc with the SD Weekly Metals and Markets Wrap. Joining us today and filling in for Eric is one of our favorite returning guests, Alasdair Macleod from Gold Money over in London. Alasdair, it's great to have you back.
It's nice to be back, Doc. Thank you very much.
Well, we always really enjoy having you on, and what a perfect time to have you back with the events that have developed over in Greece and the Eurozone over the past week. We're recording this on the semi-holiday here in the U.S., 4th of July Independence Day being observed by the markets here today on Friday. Pretty subdued trading this morning in the markets. Gold is holding in between 1165 and 1170 in dollar terms, and silver trading right around 1570 in dollar terms. What's your take here? Well, let's start with the metals, Alasdair. For all the fear and collapse that's been going on associated with Greece and the referendum coming up this weekend, we haven't seen the metals spiking, but they haven't been collapsing yet either. They've been holding pretty steady. They've drifted down a little bit here during the week, but really they've been holding fairly steady. So what's your take on the metals to start things off here today?
Well, it's rather like, I think as Sherlock Holmes would have said, the dog that didn't bark in the night. It is absolutely extraordinary that with all the systemic risk that is being highlighted by the Greek situation and the potential for it to spread elsewhere within the Eurozone, that gold is hardly moving. The other thing I think about it is that it is clear from the way currencies are moving that they're being very closely managed. I mean, earlier this week, the euro jumped very, very sharply as the Swiss National Bank went in and bought euros and sold Swiss francs. And that pushed the euro up from under 110 to over, I think, 112.70, something like that. I mean, it was a very sharp rise. And I think that sort of set the tone. Nobody dare challenge the central banks on currencies because they know that these currencies are being very closely monitored, and the central banks don't want any spread, if you like, of fear in the markets. And that, I think, is the background for gold. And this is, I mean, whether or not the exchange stabilization funds have been intervening in the gold market, I wouldn't know. I would suspect it, but I wouldn't know. But I think the background with currencies basically has kept the market quiet. And for the first half of this week, obviously, we were running up to the end of the first half. I think it suited the dealers in the futures markets to have as low a gold price and silver price as possible for the purposes of their valuations. Now that's passed, I would have expected the price of gold and silver to recover, but it didn't. It just stayed very, very quiet. Now, whether that's because America is closed today and nobody was really dealing yesterday, I don't know. But it is extraordinary, and I think that at some stage the lid is going to come off this market and it's going to move very, very sharply, probably at the same time as a number of other markets break.
And, I mean, both gold and silver have been in a correction, pushing down in that spring for quite some time. So from how markets typically work, Alasdair, once the lid does come off, there's certainly is quite a bit of potential energy for a move to the upside.
Well, you can take two views in it. I mean, you can take the view of the managed money category in the Commitment of Traders report and say that we're still in a bear market. The trend is still down, therefore shorted on rallies. Or you could take the view that gold bottomed out at 1183, which is roughly this level, give or take a % or two, back in June 2013. So, I mean, it's just moved sideways for a considerable period of time in a trading range, admittedly with the upper level of that trading range tending to come down. But it hasn't been a bad idea to bite on the dips. And I'm sure that the real buyers in the market, who basically are the Russian government and all around Asia, you know, whether it's governments or institutions in Asia, they have been acquiring gold on dips. They haven't been aggressively chasing the price up because they can see how we're trying, in the West, we're trying to talk the thing down. So they just buy the dips quietly and accumulate. And I think it's the sort of market where at some stage we're going to run out of the physical and then all hell could break loose.
And we're starting to see signs of that in the retail market here in the U.S. once again, Alasdair. The physical demand has simply exploded really over the past couple of weeks, but really it's intensified over the last probably 7 or 8 days ever since last weekend with the news in Greece. The physical investment demand has exploded. Just on the U.S. Mint's numbers, Silver Eagle sales in June exploded to just under 5 million ounces. It's the second highest total in the year after January, and the January numbers are really skewed because, number one, everybody orders the new coins for just with the new year, and also they shut down production in December, so you have a lot of December's production pushed over into that January month. So if you really didn't count that, the June numbers probably would be the highest of the year, and most of that came over the last week to 10 days even. So the numbers have exploded, almost tripled over month over May's numbers, and they've sold almost 1 million coins in July already, and we're talking about 2 days, July 1st and 2nd on a holiday week, which is quite mind-boggling to think about. Year-to-date numbers are a little over 22.5 million. And again, this is just one coin, the U.S. Mint Silver Eagle. Doesn't factor in any of the other U.S. Mint coins, much less the private mint coins, as well as the other world's sovereign coins, whether it's the British coins, the Canadian maples, all of the Perth Mint offerings, and so forth. And again, these are just the coins. We're not even talking about the bars. Here in the U.S., premiums have started to rise. We talked about on last week's show the 90% silver, which was the official U.S. coinage prior to 1964, which was composed of 90% silver. Premiums had started jumping with diminishing supplies of that, and it has carried through this week to just about all retail silver products. The private mints are backed up a couple of weeks on production. They've sold through all of their inventory. Premiums are rising. Historically, they're still well off of the levels we saw during previous big shortages. The last severe one probably 2013, the spring of 2013, when premiums really exploded. So they're not there yet, but again, this is just beginning. If we do see any further downside next week, or if we do see any further market fear with Sunday's Greek referendum, certainly things are only going to get more interesting and more scarce on the physical side here in the U.S. Alasdair, what are you guys seeing at Gold Money on the other side of the pond?
Well, you've got a far better handle, I think, on sort of coin demand than I have, because we don't deal in coins at all. Basically, I think, yes, people are accumulating at this level. I can tell you that the Greeks are buying British sovereigns. Now, there is a reason for that, because after the last war, when the Germans surrendered, the British took over the administration of Greece, and because there was no currency at all, they actually introduced the British sovereign to work as a local currency, and it's always been adopted, if you like, by the Greeks whenever they've had problems. So that, if you like, is what they would tend to hoard, and that has picked up. Demand has picked up quite strongly, I think. And presumably that's amongst the old folk who must be having the most appalling time. Other than that, I think bullion demand around Europe has picked up, particularly in Germany. But this is really from fairly low levels. I think it's too early to say that there is really, if you like, a market-changing flow of demand emanating out of Europe because of the problems we have here. But it is there, and I think as much as anything, it's to do with the price level. This is a very good price, basically, for anyone taking a long-term view to just tuck away some bullion and not worry about it. And I think increasingly people are doing that.
Shift gears a little bit here, Alasdair, and talk about Greece, what's happened over the past week, the referendum coming up on Sunday, and put that in the context of the entire EU.
Well, on the Greek thing, there has been so much disinformation about the situation, and not only that, but the press just hasn't understood what has been going on. The press has tended to be briefed by, firstly, Brussels, who have a vested interest in saying that the Greeks are crazy, and also the Prime Minister, Tsipras, who I think is a fairly flaky politician, in the sense that he, to my mind, is a far left socialist who is emotional, which, you know, was why he's elected, which is fine. But when it comes to understanding what is going on, the person you really need to concentrate on is Yanis Varoufakis. Now, right from long before this started, he wrote in his blog that you know, the way things are going in Greece is absolutely crazy. They cannot extend and pretend forever. The cost of interest on Greece's debt is crippling the economy, and that has to be addressed. You cannot go on and pretending and extending. And that actually is what he is trying to do. And I understand that every time he gets into a meeting with the finance minister, the last thing they want to talk about is economics. So this is why the referendum has been forced. And Varoufakis has gone on record of saying that, look, if they vote yes, and this is yes to the Troika's measures, not whether we leave euro, as was originally reported in the press. It's got nothing to do with leaving the euro. There is no desire by the Greek government to leave the euro. It is merely the terms, if you like, of the debt that they are addressing. Varoufakis said if they vote yes, then he will resign. And I think that his ploy in doing that is a completely honest one. He's wanting to draw to the attention of the electorate the true meaning of this vote. And because there has been so much misinformation, it was quite clear early on in the week that very few of the voters knew, when this thing was called, this referendum was called, what it was really going to be about. Now, what is interesting is that since the referendum was called, and particularly in the last 2 or 3 days, various members of the Troika, it turns out, actually agree with Varoufakis. The IMF has said that Greece needs to have a debt renegotiation. Well, where were they before as members of the Troika? Why were they insisting that that there is no Greek debt reconciliation required at all, or write down? And we now discover, and this was published on Zero Hedge, that your NSA seems to have picked up documents or correspondence between Merkel and her finance minister, Schäuble, to the effect that they agree that there should be some sort of debt write-down because the situation is completely untenable. In which case, why have they been insisting that Greece continues to submit to the Troika's crushing demands? The whole thing is actually become completely farcical. Now, the reason that the other European finance ministers have been behaving this way is they are desperately worried about one thing, and that is if they give in to Greece, then Italy is next, Portugal after that, Spain after that, and even eventually France. France is in as bad a mess as any of them. It just conceals it. So we have this situation where the main creditor, who is Germany, just doesn't want this thing to start falling apart on them. And that is why they've insisted on ignoring this reality. They're now going to have to address this reality. So I think whichever way the referendum goes, on Monday morning is going to be a new world. This idea of a red line that we will not give in, you can forget that. Because if they take that view, then they will merely hasten the destruction of the Eurozone and the currency with it. So this is a very, very important event. And I mean, I'm just absolutely amazed to find a finance minister and Varoufakis who actually has stood up for what he said over a year ago in a blog. He is actually doing it now, and, you know, more power to his elbow. Now, the problem is, of course, that you've got a far left-wing government. They are very socialist, and socialism is what has got Europe into this problem in the first place. I think the best thing, in a way, that can happen for Greece is that they really do have to face the reality. I would suggest that the best course is that they write off all their debt. They don't rely on support from outside. I mean, they can get a little bit of marginal support, but basically the idea of going along and borrowing $1 billion here and $1 billion there to keep going, forget it. They have actually got to address their real problems. It means that the banking system may well go bust, but there are lots of euros in circulation round Greece. So it's not quite the disaster which we read about, you know, about how, I mean, of course the elderly are going to suffer, of course the weak are going to suffer, but basically I think you'll find that the economy will turn into a black market economy or a grey market economy most of the time, and it will broadly work. The government will be able to collect taxes, but they will be considerably less than perhaps they had originally thought. And under those circumstances, they're going to have to cut their costs to meet their cloth. So there is the possibility, I think, of a left-wing government, because they will have the political mandate to do it, of actually reforming the economy. But it does depend on the left-wing government understanding this. Varoufakis understands it, but I don't know about his colleagues.
All right, well, Alasdair, in addition to all the focus that's been on Greece this week, what hasn't gotten a lot of attention is the collapse in the Chinese market. Let's talk about China for a little bit here.
Yes, you're right. I mean, the market's fallen 30%, and I think a lot of people have lost money. The run-up this year, it's more than doubled, I think. I don't know. I haven't got the details in front of me, but it has been a very, very speculative bubble, the Chinese market. And I understand, I don't know whether this is true, that in the early days the government encouraged people to go in and buy shares. So to an extent, they were complicit in driving prices up. Inevitably, this is the sort of thing that happens when you expand credit. And the expansion of credit that's been happening recently hasn't been going into the basic economy. It has actually been going into stocks and bonds. I wonder where else in the world that has happened. Well, it's happening in China as well as in America. Now, in the Chinese case, this has come to a halt, quite naturally, as bubbles do, by an implosion with stocks bought on margin having to be sold, and so on and so forth. Now, I think if there is a difference between the Chinese stock market bubble collapsing and bank credit contracting underneath it, the difference between China and anywhere else which has seen this is that China actually owns the banks. Now, this does give them the theoretical ability to control the rate of the collapse. In other words, they don't actually have to force the liquidation of collateral, which, let's say, an American or a European bank would have to do in exactly the same circumstances. Now, this doesn't mean, this is not necessarily a good thing, because, of course, a collapse of a bubble is a cleansing thing. It cleans the market, if you like, out of malinvestments. What the Chinese are planning to do instead is to switch their economic emphasis from manufacturing goods for us to developing the rest of Asia. They are doing their, I think it's 13th five-year plan, and that has been on the drawing board and is going to be published in October, and we know the direction in which that's going, and that is that they want to accelerate an industrial revolution throughout Asia, which will do what we did in Britain with railways and canals and so on over the period of 150 years, in the space of probably 30 to 40 years. This is a major, major change coming for Asia. And of course, China will be very much in the lead in this, in terms of contracts and all the rest of it. The West will be financing it, which is why we've all gone in for the Asia Infrastructure Investment Bank. That sort of change in emphasis, I think it is hoped under the new five-year plan that will replace what could be lost business from America and Western Europe. Business which is lost partly for political reasons, because we don't like what China's been doing with the Spratly Islands or whatever excuse we come up with, but mainly for economic reasons, because the Chinese can see that our economies are very much yesterday's story. And this, incidentally, is one of the main reasons why they want to get away from using the dollar as their international settlement currency. So China is very interesting. I don't really think that the Chinese government are going to waste too much time rescuing the market from overvaluation. I think they will ensure that it doesn't become self-feeding insofar as they can do that. But they're going to, I think, broadly let the market follow the course of events. So I mean, I can see that at some stage there will be a big bounce in the market, but this is not a market which I would look to bottom fish in, if you like.
So your take, Alasdair, is that this isn't just some sort of a temporary correction. You would definitely stay clear of China for the time being.
Well, I would stay. I mean, I'm not giving investment advice here, and it's no longer my sort of primary focus. But
I guess I would just ask in that context, as the entire Chinese economy is in a totally different place right now than, say, the UK's or the US. At least in my point of view, the US and the market bubble, their underlying economy is rolling over and has been. It's reached its peak and is rolling over. Whereas the Chinese, well, there's certainly been an epic stock bubble. Their economy overall is still on the way up.
Yes, I would agree with you. I mean, I think rather than looking at it as being on the way up, I think that they have gotten, there's a credible plan B,
right,
if you like, something which we don't have. We're in the situation where we're having to finance increasing welfare costs at the state level, and finding that the economic performance to pay for it in taxes and all the rest of it is not materializing in any way. I mean, how many times over the last 4, 5, 6 years have analysts forecast an economic recovery in the States? I'm still waiting. I mean,
we've had green shoots ever since 2009, Alasdair. What are you talking about?
Exactly. Well, yeah, okay. You might have had green shoots, but they haven't grown into anything. So, the whole there is a big problem. And of course, what's interesting is that the macroeconomic community don't actually understand the process of printing money, because what it does is it transfers wealth from the majority of people to a small minority. The small minority being the financial community, who of course run round and tell the central bank, you must print money or allow us to expand credit. They're the guys who benefit because they get the money first before the rest of us. The rest of us find that our savings are devalued, our money, our capital buys less, and if we're lucky enough to have some stocks, then okay, we get some sort of compensation. But the only way we can hold our money together is to speculate in the stock market. Now that is not a good way of running things, and this explains why it is that printing money actually destroys wealth in the economy and does not lead to an economic recovery. How can you have an economic recovery if you're destroying wealth? And this is what we're seeing, I'm afraid.
Alasdair is exactly right, and I'd like to have you back up just a little bit and expand on that a little more, because I don't think a lot of listeners fully understand, certainly many do, but I don't think everyone listening fully understands what Alasdair is getting at. So explain a little bit more, Alasdair, about why exactly the banksters or the bankers benefit when they get the printed money first. Explain that concept to people, so the average guy listening.
Of course. It's a very, very simple context. It's a concept. It's something called the Cantillon effect. This is something noticed by Richard Cantillon, who was John Law's banker in Paris in 1710. Now, John Law was the man behind the Mississippi bubble. His banker made an awful lot of money out of John Law's rigging of the markets. In fact, he rigged the markets for John Law, in a sense. He was the salesman, if you like, the bond salesman. Now, what Cantillon noticed was that when you get an expansion in the quantity of money, the people who benefit most are the people who get that money first. Now, this makes sense if you think about it, because if, let us say, the central bank gives me a few $1 billion, says, Alasdair, there you are, there's a few $1 billion, go and play with it, have some fun with it, buy a few yachts, whatever you want. I then go in and I buy, let us say, a nice new house, a nice yacht, caviar, whatever. Now, this money is completely new and adds to the total money stock, which eventually reduces or tends to reduce the value of that money, because more money, less value. But the people who I give it to in exchange for their goods don't realize this is new money. They think it is just money. The result is they don't adjust their prices for an effect that this new money is going to have on them. Less purchasing power, higher prices. But as this money is then spent into the economy, it obviously makes sense that the people who get it last find that prices have already risen against them because of this new money. And having risen against them, they haven't got the money. They have had a wealth transfer from their capital into me. And I'm very happy about this. I am rich. I'm like a banker on Wall Street. You're like the man on Main Street. Does that make sense?
I hope it does for the listeners, because it's certainly what happens. And unfortunately, and again, for the listeners who may not know a lot about my background, I previously spent a lot of time in my medical career with seniors, Medicare patients, and you would not believe the amount of Medicare patients and seniors in the United States, and I wouldn't be surprised if it's not the same in the UK. Alasdair, tell me if I'm wrong, but
you're right. We have an aging population.
Their Social Security, their pensions, whatever it is, especially with Social Security, the majority of seniors and patients that I would speak to, they had a choice to make. They could pay for their medicines, they could pay for food, or they could pay for their rent. Sometimes two, but typically never all three. And they could never understand why their pensions or their Social Security no longer paid for everything when it used to. They don't understand this concept of the money supply. All they know is their funds don't make it anymore. And it is really a direct theft from them, but it's the type that the average person can't see and identify who the real culprit is.
It is a stealthy removal of wealth. And because people don't understand money, as you rightly say, they don't understand it's happening to them. But that's actually what it is. It's a transfer of wealth from the poor to the rich. And if you listen to a politician bemoaning the fact that the gap between the rich and the poor has got wider and wider and wider, what he doesn't understand is it's his central bank's monetary policies that do it. And the sooner the politicians get to understand that point, the sooner we can get away from money printing as a cure-all, if you like. I think even Lenin said, or was it Stalin? I think it was Lenin who said the best way to destroy the middle classes is to debauch their currency. Well, that's what's happening.
They've certainly done a nice, effective job at it too, haven't they, Alasdair?
Yep, and I mean, the great thing about it, from the government's point of view, is nobody understands the process.
Exactly, and I've seen it personally countless times that probably not 1 in 1,000 understand the how or why of why their currency no longer has the purchasing power that it used to. They know that it does, they can see it, and they live it every day, but they don't understand why or what happened.
Well, that's right, and they don't understand. It's very common to say, back in 1970, I could get a 3-course lunch for 50 cents or something. What they're saying in that, actually, what they're assuming in that is that the 50 cents is the same. What has changed is the price of the meal. They got it totally wrong. What's happened is the 50 cents has gone down in purchasing power to the point where it buys hardly anything. That's what's happened. It's not the price, the cost, if you like, of the meal that's gone up.
One way I've started using to explain to people, and it's amazing, Alasdair, the way that you can see the light bulb come on. And this doesn't work for the younger generation. It only works for those who were around back in the 60s and the 50s. Is back in the U.S., say the 50s and the 60s, my grandfather owned a petrol station, and gas was around 32 cents a gallon. In silver coin terms, that's a little over a silver quarter. So you can people always here in the U.S. complain about the price of fuel, and it's $3-4 a gallon, whatever it is currently. It's about how much it was and how it used to be. People complain, oh, it used to be $1 a gallon, but someone who's old enough to remember that it used to be 40 cents a gallon. If you bring up the point that our currency is no longer silver, and that was, you could buy a gallon with just around a silver quarter, and tell them that the value of that same silver quarter right now, even after silver has been crashed all the way down to $15-16 an ounce from the recent highs near 50, you can still buy that gallon of gasoline, and even more so. So gasoline, petrol is actually cheaper in silver today than it was 50-60 years ago.
Yes, you're absolutely right. And
if you explain it like that, it's like a light bulb just turns on. You can see it in their face.
Yes, and this is one of James Turk's sort of favorite explanations, that the purchasing power of an ounce of gold hasn't changed over the millennia. Apparently, he says it, so it must be true, the cost of a decent toga back in Rome was roughly the same as the price of a decent suit today, measured in gold. Obviously not in paper money. So, yeah, I mean, but getting back to the point, it is money that is being debauched. It is money that is going down in value. And when the central bank prints, it gives that money to someone first. It doesn't, they don't do a helicopter drop. They don't give everyone the same amount of money at exactly the same time. If we did that, then all prices would rise immediately as that money is spent. And theoretically, you wouldn't lose out. I mean, theoretically. But, when you give it to the banks and you say, go and have fun with it, go and, get people doing business, then obviously you're going to drive up the prices. I mean, you can see this. The cost of things in London, where the banks are, financial centre, are considerably higher than anywhere else in the country. The bankers, the same will be true in New York. The bankers, obviously, where they've got homes in the country, which they either go to the weekend or they commute, in other words, within sort of a reasonable distance of the financial centre, they're doing up their houses. They pay plumbers, they pay tradesmen, they pay gardeners and all the rest of it. So the affluence spreads, if you like, into an area round the financial centre, which sort of grows. There will be, for example, in Britain, there's a place called Crewe where they make Bentley motor cars. The bankers go out and buy Bentley motor cars. So Bentleys are doing very well, thank you very much. So are other luxury car manufacturers like Rolls-Royce, I mean, even going down to Range Rovers and things like that. Mercedes are doing very well. Why? Because the bankers are buying cars. They're paying a lot of money for cars. They don't care about the price of a car. And so, these sort of top-end auto companies are making very good money. They have more workers, they pay more people, so there is an affluence effect which builds round the factories of these companies. So, but let's, if you're a little old lady on a fixed pension, as you rightly said, for a start, your miserable savings, the interest that the bank pays, has now gone down to nothing. Guess why? Because the central bank fixes the rate. And the purchasing power of your savings and your little pension have diminished because, the auto workers and all the rest of it sort of up the road are out, spending money in the garden centres and in the supermarkets and all the rest of it and driving up the prices with all this new money. And you haven't got it. You're on the end of this chain. So you get the rising prices, the effect of the new money, but you don't get any of the new money. That is a wealth transfer. It's actually as simple as that.
And what you described in London, since it's really the same thing here in the U.S., Alasdair, I've read recently that some of the new apartment buildings they're building in New York City, they're selling a parking space in the parking garage separately for several $100,000 that you can purchase. And in the middle of the country, you can buy a brand new, fully constructed 6-bedroom house for that price.
Absolutely. It's exactly the same. So anyway, that's the Cantillon effect. And if you ever want to read up on someone interesting in the past, he's a very interesting person, Cantillon. He made his fortune, as I say, by being, if you like, the financial advisor or banker, more correctly, to John Law. And not only that, but he acted as a stockbroker to all the aristocracy. So when it came to puffing up the Mississippi bubble, guess who supplied the stock to, the Duke of Orleans and the Duke of this and the Duke of that? It was Richard Cantillon. And he also supplied stock on margin. Now, when he saw that this thing was about to fall over, he sold all his own stock first, which is typical Wall Street behavior, by the way. And then what he did is something which is illegal, but I wouldn't be surprised if it goes on. He sold his clients' stock without telling them. And so he got out of the market, both for himself and his customers who he had lent money to. He then retired to Italy for a brief period of time, with a few chests of gold to wait and see the course of events take place, which they did. His timing was very, very good. He then went back to Paris and decided to collect from everyone who owed him money, notwithstanding the fact that he'd sold their stock at a high price, which he did. And of course, he was immensely unpopular. He then moved over to London to get away from that. He then wrote his essay on effectively economics, which was the only thing he wrote which is left over, which pointed out this effect. And he also, the other thing he pointed out was something which was rediscovered by the Austrians, and that is the complete subjectivity of prices. In other words, we don't know what the price of anything is tomorrow. We only know it when we go in there and we decide to buy something ourselves. He died mysteriously, or he disappeared. His London home caught alight. There was a big fire, and everything was destroyed. I don't think his body was ever found, so there were rumours that he might have fled the country with his ill-gotten gains. But anyway, a fascinating, a fascinating story from the past.
Certainly. Well, I suspect, Alasdair, that the listeners have gained more education in the last 30 minutes from you than they did in all of their economics courses in college.
Well, I'm very lucky. I didn't have to unlearn economics because I didn't read that at university. But some people have had to do that, and it's been quite a process, an eye-opening process for them. So, no, I think the point you make is absolutely right.
Well, before we close the show, let's just bring the show full circle to Greece. Alasdair, what is your take overall on the risk for the markets with the Greek situation, the referendum Friday, and the play out? Do you think there is a big risk of a contagion developing, or do you think that's really minimal?
I think the contagion is going to happen either way. The pace at which it happens will presumably be different if you have a yes vote compared with a no vote. With a no vote, I think that the markets will probably mark down quite sharply. It's not clear what the ECB will do, because without help from the ECB, I think the banks, which are due to open on Tuesday, are going to be in difficulties. I mean, the banks are bust, basically. It's a question of whether they've got enough cash to dole out to anyone who looks for it. I don't think they have. So I suspect that on a no vote, the banks will probably remain closed. That is, unless the ECB comes in and offers further temporary relief. I wouldn't rule that out, because the priority, I think, at that stage will be to try and hold the Eurozone together. And I think that's very, very important. If there is a yes vote, on the other hand, then I think there will be a relief rally in the markets, but I think it will be short-lived, for the very simple reason that it is absolutely clear to the various members of the Troika that any attempt to force Greece to continue to pay the interest on its debts and offer it temporary refinancing on the basis that it continues to do so is just a complete sham. We now know that from the recommendations that the IMF have given in the wake of this, and also from those NSA cables, which show that both Schäuble and Merkel in Germany fully understand the difficulties that Greece has got itself into. So I think I actually think it will be a vote no, because I think Varoufakis is making great attempts to get this message over to the public as to what it is all about. A vote yes will certainly make it easier for the ECB to come in and do something to allow the banks to continue to function. But this is only a short-term expedient. And I think that unless Germany moves away from the red line of not permitting any debt write-off whatsoever, because of the Maastricht Treaty, because of the Lisbon Treaty and all this sort of stuff, unless they move away from that, then I'm afraid the catastrophe is going to revisit quite quickly.
All right, Alasdair, we appreciate you joining us on this historic time in Europe in the vote this weekend.
Thank you very much indeed for having me on. It's been great fun.
All right, I always enjoy it, and again, one of our favorite guests. So, Alasdair Macleod from Gold Money. He submits his work to Silver Doctors. You can find it there, but all of his work is held over in the archives at goldmoney.com. Is that right?
That is correct, yes.
All right, for all of our U.S. listeners, we hope you enjoy a happy and safe 4th of July Independence Day over the weekend, and we'll certainly keep our eyes on Greece on Sunday, as well as the markets when they open in Asia Sunday night here in the U.S. So for Alasdair Macleod, this is the Doc. Thanks for tuning in to this week's SD Weekly Metals and Markets.